Good afternoon and welcome. I am David Kaufman, a partner here at Thompson Coburn in Chicago in our corporate and securities practice, and I am joined today by my colleague, an investment banker and former PE principal, Kathleen Walton, from the National Accounting and Consulting firm of Kennedy & Co. We have an exciting and informative program planned for you today. First, we want to give you a little bit of an outline of what we plan to discuss today. We're going to cover two main topics. First, the pre-planning process in advance of a liquidity event. And when I refer to a liquidity event, I'm not just referring to a sale, but most likely a transaction will involve selling 50 to 70 or 80% to a PE or other kinds of investment firm that will require retention of ownership, plus continued engagement of one or more of the principals in the business for a period of time, perhaps as long as 2 or 3 years. First, we're going to talk about the pre-planning, why it's important, and why it will enhance and increase the value that any business owner can receive in connection with a liquidity event. And then we'll talk a little bit about the process, the various steps, how it works, and also, again, reemphasizing why pre-planning matters in connection with any transaction.
In order to bring this to life and give this a little more color, we'd like to weave throughout our presentation some examples from an actual transaction that David and I worked on together just in the last few months. This is typical of many good-sized family-owned businesses. It was a successful manufacturing company that was over 40 years old, had onto its second-generation ownership, but because of that structure, substantially all of the owner's wealth was tied up in the company. There was no successor identified because the company wasn't for sale, as they say. The company had been approached by a set of financial buyers that kind of did what they did, wooed the company a little bit, provided an expression of interest with a pretty good valuation, not fantastic. And this family, 5 siblings, kind of said, what do we do next? We have this offer, where do we go? And one thing about financial buyers in particular, they're quite good at selling themselves and what that opportunity is, and often might not suggest that the company or a target engage advisors along the way. So a series of questions typically come up. What happens if you go it alone? You have maybe your general corporate attorney that you've worked with for 20 years on contract issues and IP issues perhaps. You have an accounting firm that provides your audit every year. You have your trusted advisors. Is that enough? The other question that often comes up when a company receives an expression of interest is, how much is our company worth? Is that a good price? It feels good. It's a lot of money, but is it really what the company's worth? And then lastly is, how do you get to the finish line? But more importantly than how do you get there is, should you? So with that, I think one thing to look at is to begin with the end in mind and in determining your goals. Because when you think about what the end game is, you can hopefully structure a transaction to achieve those goals. Part of that is, who is the right buyer? Who is the right buyer to help you achieve your goals? For many people, particularly those who are looking for a complete exit, it is who is providing the highest enterprise value. For some, it's, I want an ongoing role. Who do I want to partner with to kind of have that second bite at the apple, while I can take some chips off the table, put some money in the bank now, but who provides me the best chance at a second bite at the apple? One goal has to be the certainty of close. What's the right structure? Is an earn-out a possibility? Is it a total cash out? What about ongoing liability? How do I feel about that? If we think back to this example company, I mentioned that there were 5 siblings. So we had 5 different owners with 5 different goals. And part of that initial process when I met with them was to try to understand what they wanted to accomplish. Amongst that ownership group, some wanted out entirely. So they were driven more by enterprise value. One sibling in particular wanted an ongoing role, wanted to be the ongoing CEO, and wanted to have a partner to go forward with and grow the business. But one underlying item for this family, one goal was actually to resolve family conflict by having an exit available. And so being able to achieve 5 disparate goals through one transaction was a tall order. A couple other items that people might not think about in goals is whether or not a potential buyer will keep their operations where they are currently, keep that employee base. That's important to a lot of small businesses. Another great example is working with a company right now, the owner of a manufacturing business that has some health issues. So clearly that's a driver for him in terms of looking at goals. But beyond that, he's taking what we would call almost a Willy Wonka approach to finding the right buyer. For him, it's more important to get someone who's passionate about the business, passionate about continuing on with what the goals of the business have been, to the point where he would take a much reduced purchase price in order to make sure that the company went to the right Charlie.
In managing, as you can see, the advisors can be key in helping manage that complicated process. But in looking at your goals, you want to also understand what your expectations are. Clearly, most sellers or people who are involved in a process like this are focused on what's the most amount of money that they can get. And one of the important elements is there are perhaps adjustments that will increase or decrease the value that they're going to get. One of the other metrics that people look at is comparables. And it's not just comparables in the industry, but it's also what did your friend receive in a similar transaction, or what did your friend tell you they received in a similar transaction. Those are 2 different things. We also would want to examine the likely universe of potential buyers. Perhaps advisors can help you understand that entire universe and help you sort out which are the true buyers and which are the mere shoppers. Also, you need to understand what ongoing role, as Kathleen mentioned, do you want? Do you want to have an ongoing continuing role? Do you want a diminished role, or do you want to simply move on and do other things with your life? One of the other important drivers is how much time and attention are you willing to dedicate to this process? If you're willing to spend more time and effort, often you can receive a higher price, but there's always a trade-off between how much time and energy you have and how much time and energy you can dedicate to your business. So what are some of those key elements to making a successful transaction?
In looking at this pyramid, that bottom tier, preparation, expertise, and team and process really create, to me, the process falls apart without any one of those. You can get speed without one, you can maybe perhaps get leverage without one, but each element is critical. We're going to spend a good bit of today's presentation talking about that preparation piece. David mentioned the importance of that expertise and team, and then this process. And the process is, frankly, either a process or the threat of a process, because both of those will in some form create the leverage to get to a successful sale, which is, again, focusing on those goals. Time is a seller's enemy, so speed is critical. And again, preparation and your team will help you get to speed. Thinking about that time element for a minute, you never know what's going to happen either within an industry, within a business, or more macroeconomically in terms of what can impact whether or not you get to a close. So getting speed to a close is critical. The other piece is there's a huge distraction factor through a process. As much as advisors, help minimize that distraction for management to keep the focus on the business through a transaction, there's no doubt that depending upon the type of process, there is management time and concentration that has to be spent on this. And so the quicker you can get through that, the more you can sustain your current results to get to that successful sale.
So let's talk a little bit about the planning process and the things you can do in advance of any transaction to help increase your value. So often when clients come to me and or Kathleen, there's a lot of work to be done, and there's always a balance between spending time and effort on this planning process and not spending time. And again, it's trade-offs for really value, because again, we're big believers in planning ahead of time in order to maximize the value of your business. It reminds me of something I learned when I first learned to scuba dive, which is planning your dive and diving your plan. It's the same mantra that I use in being a corporate lawyer for these kinds of transactions. But in planning your dive, you also need to be flexible and be in a position to respond to change in circumstances, change in information, change in macroeconomic effects. So what are some of the values of the planning process? Keep in mind that any successful sales process begins years before there's any closing. Do you, as an owner, view your business as a buyer does? Are you ready to sell at any time? Are there market or other forces that may cause you as an owner to sell at less than an ideal time? One of the things you're trying to do through this process is to reduce the possibility of a retrade, because often there is, because of due diligence or other reasons or deterioration in the business, the buyer or the investor says, hey, I want a price reduction. And you're trying to avoid ever having that conversation. Again, as Kathleen mentioned, it's not just getting an agreement or a letter of intent at a high price, but closing that deal at a truly favorable price. So what are some of the other values of planning ahead? Well, it often can reduce the noise and confusion that's out there when a buyer is looking at a business. Buyers, by their very nature, are looking at your business like they look at every other business, except for perhaps it's a different geography or a different owner or different other metrics that they're looking at. People, buyers, not unlike people, stereotype businesses. Therefore, it's incumbent upon you, if you want to receive the maximum value, to make your business have the same look and feel of other businesses that they have looked at, with as few messy things or complications as possible. You want to identify those areas of potential concern early on and apply fixes or corrections now, perhaps a year or two in advance of ever having to deal with that with a potential buyer. You want to eliminate the diligence hiccups that happen in every transaction, because diligence really is an examination of the company's reputation and can they trust you. They will trust you, but they want to verify all the information that you're providing them. We'll spend a little bit of time also today focusing on the messaging and positioning of your company to maximize value, how you can reduce and eliminate some of the liability areas, and how you can build that momentum, which is really your credibility that you have in connection with this transaction. Always you want to remain focused on your business during the process, so the more work you can do ahead of time, the less time you're going to have to focus on during the process, so you can focus on driving your business and achieving superior results during that time. And again, as Kathleen said, speed is your advantage. Time is an enemy of all transactions. Finally, we'll talk a little bit about some estate planning, some steps that you can take now to increase the value of your business over time that you may not have as much flexibility for at a later time. So let me just go over briefly what some of these areas that we're going to spend a little bit more time on later on throughout this presentation. Corporate housekeeping. Again, are your minute books up to date? Have you approved all your corporate transactions? Have you begun to set up an electronic data room? An electronic data room is simply what it sounds like, which is a website. It's a secure website where you can house all of your important corporate or financial documents that will enable one or more parties to review them in real time at their own time. And the beauty of these electronic data rooms is there's a lot of data that they can collect about who spent how much time in each room or in each looking at documents and doing things like that. So that can also provide you with some valuable information through the process. We're going to talk a little bit about some of the financial implications and how those impact your reputation, which at the end of the day impacts value, some of the operating metrics, and also the marketing positioning. Talked a little bit, and we'll talk a little bit later about some tax planning and how that impacts transactions, and also some S-Corp issues and whether or not there's an opportunity to do an S-Corp conversion beforehand. People is a key element that sometimes is overlooked. Do you have the right people? Are they in the right positions? Intellectual property, again, we often do or suggest intellectual property audits to make sure you have all the protections in place. Is your deal team assembled and ready to go at a moment's notice? Again, we believe all this preparedness not only saves you time and money, but creates credibility, which at the end of the day is pretty much all you have in connection with one of these transactions. So let's drill down a little bit on some of these items. The first item I have down here is corporate housekeeping. Do you have all your minutes for all the number of years and all the board consents, and are they in order, and are they approving? Have you approved all the major transactions that you need to approve, and is everything neatly tied together? Have you reviewed all of your major contracts that you have? Do any of those contracts require third-party consents if, in fact, there's a transaction? Are any of your contracts expired or expiring? Do you need to go back to those vendors or customers and renew those contracts in advance of a sale? Do you have oral contracts with certain parties that you would prefer to have those committed to writing so that they're more enforceable and everyone knows what they are? And then lastly, on contracts, clients often don't spend enough time reviewing their own terms and conditions, the terms and conditions that they're selling under and the terms and conditions under which they're buying under, and often there's opportunities to improve and often modernize those. We talked a little bit about an electronic data room that either someone like Kathleen or I can help you set up and sometimes even house on our own websites. We talked a little bit about an intellectual property audit, and I'll talk a little bit more about that in a minute. Also, computer security audit. Again, this is an area of increasing scrutiny by buyers. There's no amount of due diligence that's sufficient often for these buyers. And even though you may not believe that your system, that your business is a computer or IT-heavy business, this is an area that clients are spending enormous amounts of time on. But don't just look at a computer audit as a cost. It's also hidden value, and there's often important data that's housed in there that maybe you're not taking advantage of, that if you spend some time and effort on, you could otherwise exploit. Another corporate housekeeping matter is all the constellation of employment, executive compensation, and incentive arrangements. You want to make sure you understand how they work, that they're working in accordance with your desires, that they're as tax efficient as possible, and that you've done the calculations so that if in the event of a transaction, you know on a dollar basis how much it's going to cost you to do different kinds of transaction. If these items are not addressed up front, it will delay the transaction, possibly cause retrades in the transaction, or maybe even result in a transaction not being closed.
Everybody understands the importance of the financial statements when it comes to valuing a company or even having a buyer go through diligence. But I think there are some themes that are often missed in preparation of the financial statements. You know, value is typically based upon EBITDA. Not true for every transaction, but earnings before interest, tax, depreciation, and amortization is typically how most businesses are valued. And often the view is, well, historical information is historical. There's not a lot we can do about it. And I would say that that's not necessarily true. To the extent that you prepare ahead, you have the ability to impact both your historical and your projected performance. One thing we've talked about is the importance of credibility, and at every step in diligence, there's a question of how good is management, how has this company been run, what kind of credibility do we have here to believe the results we see, to believe the information we have, and kind of what the information that they're telling us will be the projections of the business. And when you have clean financial information, it adds value. There's clarity on gross profit, on margins, on cost. I think when it comes to diligence, particularly with respect to financial statements, as well as the operating metrics that we'll talk about, I think your best defense is a good offense to really understand the information. As most of you may know, there's typically a process of coming to what's considered an adjusted EBITDA number. That allows a seller to say, this may be our EBITDA based upon our financial information, but these expenses aren't ongoing, they're one-time, they're related to this ownership group, and therefore we should get credit for them at the multiple that they're paying. And I think the one way to look at that is to say, sure, we can come up with this long list of ad decks that we want credit for. We can spend time arguing over them. We can have them spend time scrutinizing them. We can highlight these issues to them, whether they're environmental or litigation. Maybe it's related to health insurance retention. But the better method or better approach is to plan ahead and just get rid of them. To the extent that you have a year or more window of preparation, it's much better to clean those up, whether it's personal expenses, whether it's dealing with these one-offs. Let's get them off the financial statements now rather than really focus on the noise that they create and having to argue over them. One other important note is that this isn't just a P&L issue. This isn't an income statement only issue. The balance sheet matters as well. Typically, most transactions will have a working capital adjustment that really becomes a part of purchase price. And the way the working capital adjustment typically works is the buyer will come and say, based upon your historical information, we feel that we want the balance sheet that we're going to buy to have a pegged or target level of working capital. Anything above that, to the extent that there's more working capital, inures to the seller. Anything below that has to be made up by the seller or come out of purchase price. So working capital is often a huge silent issue that becomes a purchase price issue. An example is, we talked about the manufacturing company, our example company here. This company, like many family-run businesses that didn't have any debt to manage, they had no cash flow issues, they didn't have to be concerned with their current assets or their cash flow. They didn't have to manage their inventory. They didn't have to worry about what their collection time on their receivables or what their receivable levels were. And so this company had historically very high levels of inventory that they didn't need to have, and high levels of AR. And what this did, there was no preparation, no time to get those levels down to really examine what level of inventory was the appropriate level of inventory to have. As a result, for years, they had high levels of working capital, which then, of course, the buyer came back and said, well, for all these years, you've had, an average or an average level of working capital of X. That's what we want on the balance sheet at close, and they wanted to peg working capital to that level. It's very hard to say, oh, but we didn't really need that. We had excess inventory. And it's hard to undo that. And I think that that's the lesson here when you look at your historical financial statements. It's much harder to undo. It's easier to plan ahead.
Kathleen, we have a question from the audience on working capital. So are you saying we should, a business owner should manage to the lowest number of working capital?
I think that yes, with the caveat that you have to run your business. So you need a reasonable level of working capital, and particularly private equity investors are very industry focused and will have benchmarks for industry, will have seen what working capital experience has been in other companies. So to the extent that your working capital might be too low, they still have the ability to come back and say, but we think it should be here. But put your best foot forward and manage low working capital so long as it doesn't impact your business. I think the goal here with all of these preparation steps is to put your business in the best light should you want to sell. And David, as you mentioned, you should be market ready perhaps at any time given what's happening in an industry or a market. But you need to run your business. So that would be the one thing to think about there. One other thing as you look through your financial statements and work with your accountants is to really see whether there's some perhaps creative accounting or maybe issues that hadn't been uncovered that actually add value. A great example of this is the ability to capitalize any R&D expense. There's obviously specific GAAP requirements for that, but to the extent that you can capitalize some of those expenses, take those costs off the P&L, not only are you strengthening your balance sheet, but you're increasing your earnings, and being able to get a multiple at a higher level. As you look at accounting and what your processes and frankly your procedures are in connection with various expense or asset or liability classifications, it's important to think about how those impact value. Again, going back to this manufacturing example company for us, they had an improper inventory valuation. They had historically valued their inventory very low and not at at what could have been a gap position for them. And as a result, they left revenue on the balance sheet that they basically sold that they weren't able to get back. So again, if you've got time, take a look at your accounting procedures, your policies, and try to understand, is there value on the balance sheet? Is there value that you can, are there expenses that you can take off your P&L to increase those? Just as importantly as looking at the financial statements, there's another set of operating metrics that are very valuable to a sophisticated buyer. So the focus shouldn't only be on the financial metrics, but they should be on the operating metrics as well. Typically, again, we mentioned that the private equity investors typically have an industry focus and have often invested in companies similar to the target company. And as a result, they may actually have a better handle on operating metrics than the target company itself. This example, the manufacturing company that David and I worked on selling, the investor had other investments in this area, and they focused on metrics that the company hadn't. In all the years of experience, this company hadn't focused on some of these different types of metrics. And so they asked for the data to be able to do those calculations. And management had commented that, unfortunately, some of that information was actually not even readily available, which adds to that, is there credibility here in how management is running the business? In addition to that, it adds time to close and kind of moves that leverage chip a little bit. The other interesting thing is that management had commented that they wished they had looked at that information and were curious to see what those metrics were and how that might have impacted their business. So stepping back and looking at what should we be looking at, what operating metrics, what KPIs, key performance indicators are important to the business, along with what are the trends, what are we seeing in the business. Frankly, if you've got you may have a trend that you can't see that has significant value that you'd want to highlight, that maybe if through diligence the buyer finds out, they're not going to share that with you if that would have actually increased the price.
Kathleen, we have another question. A potential seller has been requested by a potential buyer to have somebody perform what they call a quality of earnings analysis. Can you explain what that is and if you think that's a good idea for someone to undertake?
I think it's a great idea to have that done ahead of time. A quality of earnings is doing an analysis of the earnings of the business and saying, where are they coming from? Are the earnings attributable to higher sales or lower costs? Ideally, if you're heading toward an event or even just in running your business, the idea is to keep your costs as low as possible. But to the extent that your increase maybe in your EBITDA growth over time is coming from cutting costs, not from your gross margin, there's a different value to that to a buyer. And so it's looking at those higher quote-unquote quality items versus artificial profits coming from, maybe there's an accounting change. I mentioned inventory valuation. To the extent that you're picking up margin because of a change of policy, a buyer's going to push back on whether that's quality or not. So really understanding the composition of those earnings is the goal of a quality of earnings, and to have that done ahead of time, either as a defense to be able to say, to get out ahead of it, or to at least be able to respond to that request. It's important. It's not only the tangible calculations that are important, whether it's the financial statements, whether it's client concentration, the operating metrics we discussed, but how you go to market adds or subtracts significant value, or has that potential anyway. And here the message is consistency. You need to have a consistent message through every element of your business, from what your website says to how things are labeled on your financial statements. For example, do you have a revenue stream? Do your revenue streams reflect quote-unquote higher value sources? For example, if you're going to market as a subscription-type model, a SaaS model, having your revenue labeled as subscription revenue is more valuable than having a quote-unquote enrollment fee that may be annual. It's kind of keeping that consistent message. Can you create multiple revenue streams from one revenue stream? How are you positioning that in your financial statements, in your discussions? I think creating that recurring revenue stream is a higher value typically has a higher value to a buyer, and so being able to create that it has value to it. I think, thinking about what type of business are you if you're going to market, rather than being approached, or even in those initial conversations when you've been approached, what are you calling your business? And understanding the label that you put on your business may provide a higher multiple depending upon the type of business. A great example of this is a company I've been speaking with recently that if you ask them what they were, they would say, well, we're a manufacturer and distributor of soft orthopedic goods. And I said to them, well, aren't you a healthcare company? And so just that marketing position ideally can get a different class of investors that would be looking at potentially a higher multiple. Of course, we've talked about the sophistication of buyers and whether they'll see through this. Part of it has to do with, we talk about leverage quite a bit, and if you get people in that competitive process, and with this label, they're going to understand that there's other people at the table, and so maybe that drives up the multiple as well. But again, the message here is consistency.
That's a great last point that can't be overemphasized. I remember I had a client that was in the barcode printer and supply business, and the CEO, when I referred to them as a barcode printer, the CEO said, no, we're a logistics solution provider because we provide the software and we provide the solutions. Solutions companies, as you can imagine, get higher multiples than people who simply make stuff. So keep that in mind. We'll talk for a few minutes about taxes, but not too much because we don't want to lose the entire audience here. One of the important aspects to look at in advance of any transaction is the current form of entity, and is there some ability, is that the most attractive form of entity that buyers look at? There's some things you can do later on, but maybe there's some actions you can take well in advance to sort of set yourself up for success. One of those issues is S corporations. Often buyers or investors cannot invest in S corporations and therefore may need to do one or more kind of restructurings, which can be done during the transaction or just before the transaction, but buyers, again, prefer all that cleanup to be done well in advance. Generally speaking, buyers prefer LLCs. They're infinitely flexible, but there are some buyers who prefer S or prefer C corporations, in part based on who their investors are, but those are more and more rare. The important thing to keep in mind is it's something to examine ahead of time and try and prepare for the future. Estate planning is one area which is often overlooked. That is very, very important, and that if you take some action now, can give a business owner the ability to transfer substantial wealth to their family or to kids or the generation beyond their kids at a reduced tax cost to them. One of the things people do is often they gift stock or LLC interest to trusts or to the kids outright, now at a lower valuation, and then later on they can reap the benefits of a higher valuation from a transaction. Keep in mind also you can bifurcate in an LLC and even in an S Corp the voting and non-voting securities, so that you can, for example, give your kid an economic interest in a business, but they would have no vote or no control, just simply an economic interest. Let's spend a few minutes talking about people, because again, this is one of those hidden value drivers that I think is often overlooked in a transaction, but can often take a fair amount of time and attention in advance in order to make sure you have the right people in the right places. And that's certainly the first question that I always ask, which is, do you have those right people in the right positions? Are those individuals properly compensated? And again, properly compensated doesn't mean you're just paying them enough, but are they incentivized appropriately? For example, we've talked a lot about EBITDA and that driving value. Is everyone's compensation tied to EBITDA or EBITDA growth? Or instead, is people's compensation tied to sales? People will often act as incentivized, and therefore it's important to keep in mind what's important and to make sure people are driving towards that value creation metric. Often in these instances, we sit down with a client and review their sales compensation package and incentives. Usually there's some tweaking that needs to be done because either the business owner does not feel that the salespeople are doing enough, or the salespeople feel that they're working on extraneous things and not driving sales. There's a lot of complexity involved in there, but it's something that's worth spending some time and energy on to not just increase sales, but also make sure you have those proper incentives in place. Benefits is an area that's often overlooked. Are your benefits package industry standard? Are they too generous? Are they not fair? Have you done everything you can to reduce executive employee liability or exposure? This is not just an insurance issue, although insurance is an important thing that needs to be examined, but are your articles, bylaws, and indemnification agreements state-of-the-art? This is an easier thing to put in place and adopt now in advance of transaction. They can be done often in connection with a transaction, but much easier to put in place now and have them adopted at that time, and then they're just simply accepted later on. Finally, have you really spent the time to review your team? Does your team have what it takes to move the company to the next level? Have you made the right investments in people? It's not just having those right people, but do those right people have the right skills? Do they need training to do what they could do or what is required for the company? The best example I have is an individual who was really a good controller but needed some additional training to really step up and be the CFO of the company.
David, how do you advise clients to handle employees, particularly key employees, during a transaction?
So there's a bunch of different aspects. That's a great question. There are a bunch of different aspects involved in that. The short answer is it's difficult, and every company is different, and every culture is different, and every management team or ownership group looks at these things differently. Typically, one of the first issues is confidentiality, and generally speaking, the fewer people you tell, the fewer people are going to know about this and start spreading rumors. So one of the important elements is obviously confidentiality and who you bring in under the tent. But also part of that is the flip side is sort of transparency and making sure the people that are important, to getting the deal done, are aware and are all working hard to make that happen. And one of the ways you do that is often implementing retention plans of one kind or another, as simple as cash payouts, or can be complicated in employment agreements or in other things, and that's something you should look at to make sure the right people are incentivized to work hard to help you close your transaction. Intellectual property is something we teed up earlier here, and generally speaking, when clients come to us on something like this, we look at doing what I would call an IP audit, and this is really a 360-degree view of the intellectual property of the company, both from an offensive and defensive position. What does the company have? What does the company need? What have they licensed, and what are they licensing out to third parties? This is, it may look like simply a cost center, but there's enormous value that has been driven from intellectual property of lots of things that people didn't even take and think of as intellectual property, even as a few years ago. One of those areas is obviously patents and license agreements, particularly if things are expiring soon. Do you have the right agreement? Do you have the right agreements in place with your employees so that everything that they develop is owned by the company? Those are often agreements harder to sign years and years later, but can be done. You've got to think hard about how important IP is to the business. And again, even businesses that you don't think are IP-heavy businesses, there is generally know-how and knowledge that is critically important to the success of the business. And looking at software and other kinds of licenses. One area that's often overlooked is joint venture agreements, because often there's hidden IP either licensed one way or the other. That's an important element that should be examined. One of the other important matters that we'll mention here on the pre-planning stage is the deal team. Experience really does matter, and it's not just industry experience, or have they done these kinds of transactions? What is your lawyer or your accountant or your financial advisor's experience in the industry, and what is their reputation in the industry? Do they instill fear in the hearts of their opposition? I always like to make sure that the other side's eyes, in essence, roll when they hear that I'm going to be involved, for example, because they know they're getting somebody who's smart and good and is going to hold their feet to the fire. So you really do need people who've done this, who know the drill and know the dance and have done this a lot. So you've taken Kathleen's advice, my advice, and you've spent a fair amount of time planning ahead. Now we're going to get into a little bit about what the process is.
Here we have 9 boxes for a very long process. So clearly this is oversimplified, but I think we're going to hit on some of the key points here in terms of the process and the different thought points along the way. We talked about beginning with the end in mind, and I mentioned how those goals need to permeate every step along the process. So from there, I think it's important before you even start, I think David mentioned earlier, is to look at that buyer universe. That's a bit of a gut check against the expectations, whether it's value expectations, whether it's the ability to continue in the business, where the business will be located, who are the likely buyers, and are they likely to let you achieve your goals? And then you've done all this prep work. You spent 18 months getting your financials in order. You've started to manage your business differently. You've made sure you've got the key team in place to show a management team that can grow with the business. Then it's time to kind of begin that diligence, pulling together all those contracts that you've made sure that you have, which ones you need consent for, that corporate housekeeping that Dave spoke of. Everything's in place. That virtual data room is fully stocked. In connection with that, simultaneously, your advisors will be helping you prepare the marketing materials. And typically, there's some sort of a marketing document, a fuller marketing document, whether it's ranging from 20 pages on the small side to 80 pages on the long end, that describe your business in detail, that kind of make the highlights, that really have that consistent message that we talked about before you go to market. And in terms of going to market, typically a blind or anonymous very short executive summary goes out to those kind of qualified buyers to look at people who might be interested in this. Hopefully, again, focusing on confidentiality, not giving away too much, just to see who's interested. For those that are interested, they'll have to sign an NDA. The question often comes up about, well, does an NDA really provide protection? It's a contract. Like any other contract, people can breach them, people can live with them. Are there ramifications for a breach of contract? Of course. But at that point, the cat's out of the bag. And so part of ensuring the confidentiality that you want, again, is to look at that buyer universe and understand who has a good reputation for being a good buyer, for being someone who's going to examine businesses and keep that confidentiality. I think it's rare to have a breach of an NDA, but it does happen. So as you go to market then, you provide more information, and the process is a bit of a funnel in terms of qualifying buyers at every step along the way. And in terms of qualifying buyers, your advisor's job here is to make sure that as you're letting out more information, more access to different layers in the data room, that you've got buyers who have the financial wherewithal to close a transaction, are steeped in the industry, have done deals. I think a really important thing here is to understand whether these are potential buyers who get to a close. Are these just the buyers who just want the information, want the industry information, want the benchmarking that often more information and more diligence provides? Are they competitors that are fishing for information? And sure, they might keep that information confidential pursuant to the NDA, but are they just looking for more and more information? I think the other kind of softer side of qualifying buyers really relates to the ongoing partnership for those owners and managers who will have an ongoing role. You're qualifying them. Are these people that I want to work with? What's their reputation? As much as they're looking at your reputation and credibility, what's their reputation? How do they work with their management teams? And I think, as I mentioned earlier, I think generally private equity firms are fantastic at selling themselves. They're great, they're charming, they've got great industry expertise, and everything seems like it's going to be great, but understanding how a buyer will react when things don't necessarily go to plan, and being able to hopefully do some diligence of your own as you go through this process is very important. Eventually, you're going to get down to a short list of finalists that often leads to a staged indication of interest, range of value, again, that qualification process that we talked about, and then an LOI process, getting to a letter of intent.
Kathleen, interrupt you for a second about the LOI or letter of intent. We have a question in the listener asks, what exactly is a letter of intent? And they put it in front of me, should I sign it?
The letter of intent is a much, I mentioned indication of interest, which is often people saying, yeah, I like what I've heard, here's a range of value, gets them to the next stage. And a letter of intent creates, frankly, an obligation on behalf of typically the seller, but locks in the purchase price and some other terms, and provides a period of exclusivity where a seller can only talk to that buyer, can only be negotiating that deal with that buyer. There's varied views on whether or not a seller should sign an LOI. In my role, I like them, and I encourage, I like LOIs for several reasons. One, I like getting a commitment to a price. Prices don't go up during diligence. Prices only go down. David, you talked about what we call a retrade based upon diligence. Prices go down. But I like to have that price and that multiple established and keep people's feet to the fire. I think, you look back on those foundations, those building blocks of a successful sale, and some of those leverage and speed, critical pieces, how are those impacted by an LOI? And I think you could argue that you're removing the competitive pressure by entering into an LOI with somebody. I think that by limiting exclusivity to a very tight time frame and limiting diligence to that tight time period actually does create additional pressure on the buyer in a full process. I think it's less effective when there's not a process around it. And some buyers won't move forward without an LOI as well. One other thing I want to mention is I think that an LOI also allows the ability to pre-negotiate some threshold issues. A great example of a transaction I worked on recently, we pre-negotiated the scope of the non-compete because that was a critical part of this. And what happened when we got down the road and were negotiating the purchase documents is that the buyers or the investors, attorneys came back with a stricter non-compete. And it was easy to go back and say, no, this is what we agreed upon. Structure is another one of those. If it's important, if there's a tax structure that's driving value, I think that's important to have that connected to the purchase price.
I'm going to disagree a little bit, Kathleen. From my perspective, I'm not a big fan of letters of intent, mostly for a couple reasons. I'm all in favor of making sure everyone's on the same page, particularly on the price and terms and material, other conditions, non-competes, baskets, indemnification, all that sort of stuff. I like to know we're all on the same page on that. But generally speaking, that's going to limit my flexibility as a seller of a business because there is going to be a standstill. And for some period of time, I'm not going to be able to talk to any other potential buyers. And often we spend a fair amount of time figuring out what the trigger is and trying to come up with a mechanism where me as a seller thinks the buyer is not pushing as hard to get this deal done and is simply running out the clock to keep this business off the market for some period of time because they think, again, me representing the seller is going to just simply capitulate. The other concern with letters of intent I have is they take a certain amount of time, money, and effort to negotiate. And if we know the basics of the deal, I'd rather spend that time and money and effort negotiating the purchase agreement than doing the letter of intent. I've never closed a deal on a letter of intent, but I've obviously closed deals on agreements and would love to get to that agreement.
The age-old question. So the rest of the process is really what, David, what you were talking about, that structure, negotiating, closing a transaction to get to the end game, hopefully, which is achieving those goals. In terms of sales process, I think there's a spectrum here. that ranges from a negotiated sale, more of a one-on-one transaction, similar to this example that we talked about where the company wasn't for sale, a buyer comes in and lobs in an interest, and the desire of that ownership team was to negotiate only with that buyer. Kind of the obvious advantages, disadvantages, we've talked about the importance of leverage. You lose that leverage without the process. I think you can gain some of that, though, by having an experienced advisor with you, because that creates the threat of going out to market and the threat of a potential process and competition. I think one problem here is that you never know for sure what the market value is. David talked about comparable transactions and kind of knowing other businesses that have sold, but until you go to market, knowing that true value can be difficult. On the other side of the spectrum is a broad auction, kind of going out to everybody who might have an interest in this. The risks here are loss of confidentiality and, frankly, process. I think a broader auction, unless tightly controlled, can lead to a longer time frame, which it almost does a disadvantage to the process. That limited auction in the middle is where I think I like to be generally, creates enough competition but is easily maintained.
Let's talk for a second about potential buyers. Generally speaking, people put the different kind of buyers into two different buckets, strategic buyers and financial buyers. Strategic buyers, generally speaking, are competitors, people who are in the industry, who know the business very well, have a very long-term view of the industry. They're generally looking at figuring out how they can increase value because of synergies or entering into new markets or getting new customers or picking up a tangential product line. It's a better way for them to grow through acquisitions. Financial buyers, again, generally speaking, are focused on return, and they're focused on a shorter term return because they're likely investing from other people's money, and the other people want that money back with the return after some reasonable period of time, 3, 5, 7 years, something like that. So they're focused often more on return and more financially metric driven, although there's been a lot of there are many buyers that sort of fit into one or more of these categories and mixing, and it's probably disingenuous to say the strategic buyers look at things only one way or the financial buyers only look at one way, because often they're often very mixed. And one thing I will mention is cyclically, depending upon where we are in the business cycle, sometimes people view one group of buyers willing to pay more. Right now, I would say, and obviously interested to hear Kathleen's perspective, that PE firms or financial buyers are generally paying more, in part because they have a lot of capital, they have to put the capital to work, and also because of debt costs and how low they are these days.
I agree. I think traditionally everybody always assumed that strategic buyers would pay more, and now with the glut of money needing to be put to work, the low interest rates, I think we're seeing significant increase of multiples from financial buyers. We've talked about the benefits of a competitive process throughout, but I think one thing we didn't touch on is the fact that that process, whether or not you sign an LOI, often provides you with backup participants should a buyer fall out that you might not otherwise have if you undertake a process. I think the other part of a competitive process I mentioned earlier through the qualification process allows you to pick the quote-unquote right partner for you, whether it's, again, keeping your business local, whether it's how will they be involved in your business going forward. Those things, a process gives you more to choose from in terms of finding the right match.
In the few remaining minutes we have, I want to just walk you through briefly a typical deal timeline, in part to give people a sense as to how long sometimes these transactions can take. And that's usually the first question that I get from a client, which is how long is this going to take, along with how much is this going to cost. And as you can tell by looking at this, it generally is going to take, and what I tell them is, this may take longer than you expect, and it's definitely going to take longer than it has previously. I've signed, and I'm sure Kathleen's done the same thing, signed and closed deals in as short as a few weeks, but I've also done deals that have taken as long as a year or more to sign and to close. many of these steps, as you can see, can be done sort of simultaneously as we overlap, doing some of the things at the same time. And as you'll see, really the two first large boxes, the initiating engagement and preparing the company and preparing to go to market, maybe as long as, in this example, we have 8 weeks. Often, if you do some of the pre-planning that we talked about previously, that can reduce that time to market. And again, as we've talked, time is money, and time is your enemy of all kinds of transactions. So generally speaking, those big box steps are doing some of that pre-planning, structuring, tax consideration, doing whatever you can to increase value, bringing the company to market, doing some of the things Kathleen mentioned about researching target buyers, creating a target buyer list, making sure the client, the seller of the business, has signed off on those target buyers. They may have names to add to that list. Creating marketing materials, whether it's a teaser and or some sort of deal book or PPM. And then the process of going out to the buyers, qualifying the buyers, having them sign NDAs, getting preliminary indications of interest, maybe even getting a letter of intent. I included there, including a form agreement. Sometimes if you have a frothy auction, my suggestion is to include, in fact, a form purchase agreement so you can get on a granular level what exactly all the comments would be from the other side, so you can quickly and hopefully put everyone through that funnel and decide who is going to be the best buyer, and then just negotiate based on price and some terms. Then we have the final steps of hopefully the final due diligence, whatever financing issues the buyer may have and or the seller may have to deal with them, negotiating the documents, and managing the closing and beginning the transition process. I think it's always important to start that transition process as early as you can in this transaction because that's going to set you up for success later on. Thank you again on behalf of Thompson Coburn and Kennedy & Co. And feel free to continue the conversation with either of us. We have provided in this presentation our contact information, and obviously happy to continue the dialogue or answer any questions you may have on a going forward basis. Thank you very much. Have a good afternoon.